So this is part two of the multi-part multi-part video series, which I am preparing to add value to those people who do not have time to look at daily time frame charts. They only want to trade the weekly charts and they do not want to take swing trades. They only want to focus on positional trading. Okay. So this is part two of this multi-part video series. I don't know how many parts this will become, but let's take it one part at a time. In the first part, we looked at the weekly chart layout. I always like to start with charts because that's where the real fun is. And we will look at multiple charts. Okay. In this video series, to make sure that you understand the concept. So, for example, I will draw the pivot point, I will draw the selling range, buying range. We will look at those things. We will look at examples as well. I don't know. It's a rough plan in my mind. As of now, I am just taking it one part at a time. When I'm making part one, I don't know what I'm going to talk about in part two. When I'm making part two, I have no idea what I'm going to talk about in part three. Okay. It's just coming from my intuition, so to speak. So this is about the important factors for positional stock traders. So you have made a decision that you will never take a swing trade. You only want to trade positional stocks. Okay. And you have also made a decision that you will only take trades on a weekly chart. That means you will not check the monthly, you will not check the daily, you will not go to 15-minute time frame charts or intraday or whatever. You will only stick to one time frame. Okay. Once you have taken that decision, and by the way, I commend you for taking that decision if you have taken that decision, because this single decision alone reduces significant amount of risk in your portfolio. When you are consciously saying no to swing trading, you are saying no to all stocks which are fundamentally weak. By the way, I don't do that. I am a swing trader and a positional trader. Even Mark Minervini is a swing trader and a positional trader because we have time. I can look at the stocks on a daily basis. I can spend good amount of time daily in looking at stocks, right? Even Mark Minervini. William O'Neill was a positional stock trader. He was running a company, so he only looked at weekly charts. Now, what are the factors? Once you have made that decision, you have significantly reduced risk in your portfolio. However, the flip side of that is you have also reduced the number of opportunities that come your way. So, although you might get less number of opportunities in a year, maybe one stock a week, or maybe one stock every 2 weeks, but the probability of that setup is going to be high. The probability of success for that trade setup is going to be high. A, because you are trading the higher time frame chart. B, you are giving more weightage to the fundamentals. You are sticking to those stocks which have proven themselves fundamentally in their core business. So this is a list of factors that I have prepared based on my understanding of O'Neill and his methods. And directly, indirectly, I use this in my daily chart trading as well. So let us discuss this. As a positional stock trader on the weekly time frame chart, your focus should be the 50-day simple moving average, more specifically 10-week simple moving average. So the blue line that we saw in part one, that was the 10-week simple moving average. Okay. As long as the stock remains above that line, we are doing fine. But if the stock closes below that line on high volume, then there is trouble. If it closes below that 10-week SMA on low volume, well, we can give the stock some time, maybe another week or so, by keeping the stop loss at the low of that week. Anyways, we'll discuss that on the chart. Secondly, your focus is on weekly time frame chart, so it becomes easy for you. So you identify the buy point, you put the alert. When the stock enters your buying range on the weekly chart, you can anytime uh, take the trade from your mobile phone. Okay, so you work with alerts because you don't have time to spend daily filtering, looking for stocks. Okay, Next, confirmed uptrend. Obviously, this is the basics of what William O'Neill and Mark Minervini have found out, that 98% of all the leading stocks of the past were already in a confirmed stage 2 uptrend. So, by being in those stocks which are already in a confirmed stage 2 uptrend, we are increasing the probability of our success. This I already discussed. We give more weightage to fundamentals in positional trading, swing trading. That is not the case. So, the stocks that you are going to buy have to be fundamentally strong. Okay, and I will discuss what fundamental criteria to look for in this multi-part video series. Maybe it will be part 4 or part 5, whatever. And we'll create a filter on MarketSmith for this. And of course, there is no specific target, because if a company continues to grow its earnings, sales, uh, if it continues to expand the business, what is the need to sell the stock when you already have a winner? What is the need to sell the stock unless you have a technical sell signal or the market conditions have changed and things like that? So, no specific target, but we do uh, involve in something called as partial selling, which we will discuss. Time horizon is generally 6 to 24 months. Remember, there are 5 bases in a confirmed stage 2 uptrend. Base 1 and base 2 are called investable bases, early stage bases. Base number 3 is called a tradable base according to Mark Minervini. Base 4 and 5 are called late stage bases. By the time the stock reaches base 4, base 5, the probability of success is less than 20%, which means at base 4, base 5, the success rate or the probability of failure is more than 80%. Okay, so please understand the importance of the base count. Okay, and time horizon from base 1 to base 5. See, by the time the stock goes from base 1 to base 3, could be 12 months. From base 3 to base 5, it could be another 12 months. So, around 6 to 24 months, that would be the holding period. This is not a long term stock investing strategy. This is not investing, this is trading. Okay, for investing, you have a minimum time frame of 5 to 10 years. I would say at least 10 years. But this is trading. You go along with the stock as long as it remains above the 10-week simple moving average. If it closes below the 10-week simple moving average on high volume, that's a sign of trouble. Next, you basically look for the CAN-SLIM characteristics. CAN-SLIM is an acronym. So C stands for current earnings, EPS. A stands for annual earnings. This is basically in the orange trading system, we look for basic characteristics which overlap with this. N means new product, new management. It could also mean new high. Okay. S means supply of shares, supply demand. So, how many shares are outstanding? How many are free float? Uh, what's the institutional holding? The problem with S is that if the institutional holding is too small, then how will the stock go up? Who will buy? Because after you buy, the institutions need to buy for you to make money, right? So, institutional holding, if it is small, there is a problem. If institutional holding is extraordinarily large, again, there is a supply side problem. If all of those institutions suddenly decide to sell, the stock could collapse like 40% in 2 weeks. So we can't have less supply, we can't have more supply. Okay, there needs to be a balance. L is leadership. So this is leading stock which has good comparative strength. So relative strength, industry group rank, things like that. I means institutional sponsorship. So we do that with filters. So we look for stocks which have a buyer demand of A or B. M is market condition that you already know. So that is my understanding of CAN-SLIM. I could have been wrong in one of these acronyms. You can just check William O'Neill's book. But this is what I understand. Okay. Then there is a specific pivot point, which is the buy point marked on the MarketSmith chart. So you don't need to sit there and identify whether this pattern is a cup with handle pattern, or it's a double bottom, or it's a flat base, or it's an ascending base, or it's a high tide flag, whatever. These are all the patterns mentioned in O'Neill's book. I have not studied those patterns in detail because I found them very confusing. I found it difficult to spot a cup with handle. Okay, that is why I created the point system for myself on the daily chart. For the weekly chart, they give you the buy point. So there is a green dotted line, that's the pivot point. They also mark the proper base with green color on the chart. So that's the pivot point. Okay, so if they already give you what is the buy point, why to spend time uh, trying to identify the pattern? I will teach you the basics of the base in a stage 2 uptrend on the weekly chart, because we need to know when has the base really started. Okay, that is something we need to know. We don't need to look at uh, the exact pattern. Okay, so pivot point is an important concept. Then the buying range along with pivot point, I should mention here the buying range, it's 5% from the pivot point. Anything that is beyond 5%, that means you're buying the stock extended. Then there is selling range. I think this is 7 to 8% from the pivot point. The target range is 20 to 25% from the pivot point. I will confirm this. I will check O'Neill's material, but that this is my understanding as of now. Okay. So there is a selling range. Why do we have a target range when I mention here no specific target? Because generally, when the stock goes up like 20 25% in a very short period of time, it makes sense to lighten up on the position, take some money off the table, wait for another base to form, and then pyramid into the stock. Because it's a uh, it's normal for stocks to go up 20 25% and then begin to form a base again. Okay, so target range is important. So on market smith chart, you will see the green band. You will also see the red band on the chart. The red band is the stop loss range. When the stock enters that range, it makes sense to sell. And there is green band, which is the selling range. When the stock enters that range, we could think of lightening up on our position. And by the way, you have to buy this book, How to Make Money in Stocks by William O'Neill. This is the only book you need, because the moment you declare to yourself that you will never take a swing trade, then by default you are a positional trader. By default you are a weekly chart trader, and all the charts in this book are weekly. Okay, this book is specifically for positional traders. Rather than reading 5 books on trading, why not just buy one book and read it 5 times? That makes more sense to me. So buy this book and read it 5 times over a period of 1 year. Okay, you read the book, you apply the concepts. Again, after some time, you read the book. Again, you apply the concepts. Again, you read the book. Again, you apply the concepts. That way, your process will get refined and refined over a period of time. Okay, so these are the factors that you should be considering. If you want to add more to this, you can do that, but these are the main things. Okay, and fundamental characteristics, we look at only 4 things: EPS, sales, return on equity, and margin. Okay, and we will dig deeper into that. In this video, I just wanted to make sure that you know what are the things to look for when it comes to stock selection, trade execution, and trade management. Okay, the moving averages, the confirmed uptrend, fundamentals, no specific target, time horizon, that is trade management. Pivot point, SL range, target range, that is trade execution. Can slim characteristics, the book, etc., weekly chart, this is stock selection. So as a positional trader, when you do your trade journaling, you have to assess yourself based on 3 skills that you have acquired: your stock selection, trade execution, trade management. Okay, thank you so much. I hope this video was helpful. Now you know what to look for. Okay, these are the most important things that you need to learn. Okay, let's see what we will discuss in part 3. Maybe the fundamental characteristics, or maybe proper filtering of stocks. Okay.